Welcome and thank you for joining. Over the past year, gold and silver performance has been extraordinary. What began as a textbook demonstration of precious metal doing exactly what they should, diversifying portfolio, protecting against inflation, and hedging geopolitical risk, ultimately turned into a dramatic and unexpected breakdown. In this presentation, we will explore the full journey. Why gold and silver remain essential diversifiers in multi-asset portfolios, how they performed during the remarkable run-up, and, most importantly, what triggered the sudden collapse across the precious metal complex. Gold had a fantastic run in 2025, generating over 60%. But at the end of January, the entire precious metal complex suddenly sold off. Three catalysts explain the shock. One, a macro shift with a new Fed chairman nominee. Two, a breaking point in the silver bubble. Three, forced liquidation in China. Precious metals have a structural role to play in the portfolio. Over the long term, their relationship to stock market is close to zero, meaning it often moves independently from shares. This low relationship helps steady a portfolio, especially when equity are under pressure. But precious metals are also volatile assets in their own right, with price that can move sharply over short periods. This is why the right allocation size matters. Even a small exposure can deliver meaningful diversification. As you can see in this chart, gold tends to hold up and often rising during major stock market sell-off. This is why gold continues to earn its place as a defensive allocation, particularly in extreme market events. From war to political shocks, gold has repeatedly behaved as a geopolitical hedge. The data shows that gold often outperforms equity during global crises, offering protection in unpredictable environments. This long-term chart reinforces gold's reputation as a store of value against inflation. Although not perfect in the short term, over multi-year cycle, gold reliably preserves purchasing power in high inflation environments. All those reasons explain why gold have a place in the portfolio. After a very strong 2025, on the 30th of January, both gold and silver sold off aggressively. And that sell-off started with a policy shock. Markets were caught off guard by Kevin Warsh's nomination. Known for favoring lower inflation and higher rate, his appointment pushed rate expectation, strengthened the dollar, and lifted long-term yield. This sudden shift forced investors to cut risk, and precious metals, especially silver, were hit first. What was initially a policy shock was then compounded by a speculative bubble collapsing. Silver positioning went beyond elevated. It became absurd. At the peak of the frenzy, the main silver exchange-traded fund was trading more volume than equity giants like Apple or Shell. Positioning was very speculative. This wasn't fundamental demand. It was momentum chasing speculation. The market was primed for reversal, and once the flow turned, the crash was mechanical and violent. And Chinese pressure amplified the move. Funding stress in China forced investors to raise cash quickly, leading them to sell the most liquid asset first, including precious metal. This added a second wave of pressure on gold and silver, turning a macro shock into a broader liquidity-driven sell-off. Precious metals remain a strategic component of diversified portfolio, but their role is dynamic, not static. As markets shift, so must be the positioning. The events of early 2026 were a reminder that even fundamentally strong assets can move sharply when macro force and investor positioning collide. Gold continued to earn its place as a long-term store of value and powerful risk diversifier. As I've talked about investment, I must remind you that capital invested is at risk and future performance cannot be guaranteed. If you have any question or comment, please contact your financial advisor. Thank you for your attention.